Hello class, this is our PowerPoint and description of some of the material, the last topics for this semester. We're going to talk about changes in equity and how some of the things we talk about change our equities and how that looks on the statement of changes in stockholders' equity, statement we introduced way back at the beginning of the semester, but now we've got a little better understanding of some of the elements, so we'll be able to see how those change that. We'll talk a little bit about bonds or long-term liabilities that we haven't really considered yet, and bonds and why they're different than regular loans that we've talked about. And we're going to talk about some ratios. And you're going to have the ability to practice those in the financial report you're doing about GAAP. Hopefully this will give you just a little better background on how to do those. Most of those should be review, as well as much of what you've done and we'll do with bonds. So let's get at it here. So what changes in stockholders' equity are we worried about? First of all, treasury stock. When we buy treasury stock using the cost method, we're going to debit treasury stock, an actual account, a contra account under stockholders' equity as a subtraction from stockholders' equity, and we're going to credit cash. That's using the cost method. Now, some companies use the par method, which means when you buy the stock back, instead of creating a treasury stock account, you debit the common stock, additional paid-in capital that you originally credited when you sell it. So when you sell stock, you credit common stock and additional paid-in capital and debit cash. So then when you're dealing with treasury stock and you buy it back, that's what treasury stock is, then you're going to debit additional paid-in capital and debit common stock and credit cash. And any difference is going to go to retained earnings. So there's two ways of doing purchases. Most companies record it using the cost method. So most companies are going to have a treasury stock. Typically, if you have no intention of reselling it again, you might use the par value method and not the treasury stock method. The treasury stock method or the cost method is usually if you're going to sell it again, or there might be a possibility you'd sell it again. The other is for when you're going to buy it and retire it. Now, if you sell the treasury stock, you're going to debit cash and credit treasury stock, not common stock, not additional paid-in capital, but credit treasury stock for the cost of that stock when you bought it. So when you purchased it, you're going to look back in the records, see what you bought it for at that point, and when you sell it, you're going to credit it. And you typically use the FIFO method. If you were treating this stock like inventory, you would go back to the oldest cost that you bought it for. The difference between the original cost when you bought it and the cash you receive when you sell it is not a gain, it is a credit or a debit to additional paid-in capital. It is not a gain or loss. Okay? So that's important to remember. So if we look at a company's statement of changes in stockholders' equity, in this case Home Depot, that uses the cost method, the treasury stock, notice, like we learned, there is a column on the statement of changes in stockholders' equity for each of the items on the balance sheet. So on the balance sheet, there's shares are in parentheses, and then the amount of common stock, paid-in capital, retained earnings, other comprehensive income back from earlier on, and then treasury stock. So Home Depot has in their treasury 520 million shares. They bought back 53 more, so 53 million more, up to 573. They paid exactly $7 billion. In fact, that's what they authorized the board to spend, is $7 billion, bought as many shares as they could for $7 billion. And so the debit to treasury stock was $7 billion. It went from 33,194 to 40,194, and the credit would have been to cash. So that's the treasury stock method, or the cost method. The Lowe's uses the par method, par value method. They bought stock back. Notice they have no column for treasury stock. Instead, they reduce the number of shares and debit the amount of common stock. Debit common stock makes it go down because the normal balance is a credit. They went back and figured out what this stock, when they bought it, what they sold it for, what additional paid in capital was there. So capital in excess of par value is the same thing as additional paid in capital, and it made that go down as well. So that went down, that went down, okay? But they actually paid more for it than what they originally sold it for. The difference goes to retained earnings. In this case, because it is a subtraction or a negative number, that would be a debit to retained earnings, because again, the normal balance for retained earnings is a credit. So that's how treasury stock works and how it looks on the statement of changes in stockholders' equity. Stock splits technically are a non-transaction. All that's going to happen in a stock split is the number of shares are going to increase, but the actual amounts on the balance sheet are not going to change. So if you were going to see a stock split, there would be an amount here in the shares, but there would be no change in any other column for Home Depot if they did a stock split. There would just be, if it was 2 for 1, twice as many shares as there was before. Now, stock dividends are close to a stock split, but have an important difference. Stock dividends are usually a percentage. So a company might announce that they're going to give a stock dividend of 20%. That means for every 100 shares you have, you're going to get 20 more. You're not going to get any cash, you're just going to get some more stock. And once again, nothing really changes with the company, because it's not like they are better or something like that. It just means that there's more pieces, it's cut up in more pieces. So like a stock split, it really is not a big transaction in the sense that it doesn't affect the company. Stock splits, I like to say, is like everybody, say you slice your pizza up into 8 slices, all right, and then everybody gave their pizza back, and we cut each piece into 2 pieces. So now there's 16 pieces. Woohoo, you have 16, but your piece of pizza, while it's cut in half, is still the same amount. And so everybody's in the same boat. They just have 2 pieces instead of 1, but they have the same amount of pizza. And stock dividends is very similar in that instead of cutting it in half, you might cut it into by a percentage. So stock dividends, though, according to GAAP, are accounted for a little differently than stock splits, because we actually do make a journal entry. We're going to debit retained earnings and credit common stock or additional paid in capital, usually, sometimes both. So you're going to move money from retained earnings to paid in capital. So the total stockholders' equity is not going to change. Well, you're going to debit retained earnings, making it go down, and increase capital stock or common stock. If it is a large stock dividend, you should only see common stock go up because it will be done at par value. And if it's a small stock dividend, it will be done at market value, and so you'll see common stock and additional paid-in capital go up. Stock dividends have become very rare in the real world. In fact, it's almost impossible to find an example to show you what the accounting is for that. Now, here's what actually happens most of the time in real life. Stock splits are more common by far than stock dividends, but here's what most companies do. They do not actually do a true stock split. Most of the time, a stock split is accounted for as 100% stock dividend. That means that they're going to give you 100% of the shares that you already have, which is the same in practicality for the shareholders as a stock split, 2-for-1. So that's how most of the time. But that means that even though it acts like a stock split, it's going to be accounted for like a stock dividend. And you will actually see a change in common stock and retained earnings, meaning retained earnings goes down and common stock goes up for that 100% stock dividend for the amount of the par value of the new shares that are issued. So that's kind of how those work. We have already reviewed share-based compensation. All right, we know that that affects stockholders' equity. Typically, the paid-in capital. Okay, so you'll see employee stock plans and stock options. You'll see the paid-in capital effect column that's happening here, whether you have Lowe's or Home Depot. Both of them have that same thing. Most of the effect is in the capital in excess of par value or additional paid-in capital columns for share-based compensation. And we saw that when we did our journal entries in the section on share-based compensation or stock compensation. The last change that I want to make sure that you know how it works is conversion of bonds. That we're talking about is a bond that is convertible into stock, where the holder of or investor in the bonds can trade in their bonds for stock instead of for cash. Now, normally, a bond is a loan and is paid off by the company in cash at maturity date. But some of them have a conversion feature, and the reason that companies offer this conversion is it usually gives you a lower interest rate because the person who's buying the bonds knows that they might get a better deal with the stock than cash. So you actually could get more in terms of what you receive from issuing the stock. Now, you would never, you always get to choose, or almost always you get to choose whether you get cash or stock, and of course you will choose the most advantageous. So let's say if a bond would pay you $1,000, pay off the bond, or 50 shares of stock. 50 shares of stock at $20 is exactly $1,000. But if the stock price was higher, you would have an incentive to choose stock instead of the cash, because you would get more, something that's worth more than $1,000 as payoff. So, if this conversion happens, what does it do to stockholders' equity? Well, if we were in a situation here, what we would see is that you would debit the bonds and you would credit common stock and paid-in capital just like you would if you originally sold the stock in the first place. Most of the time, you're going to debit the bonds and credit common stock and additional paid-in capital for exactly the same amounts, meaning if the bonds are on your carrying amount is $500, you're going to credit common stock for the par value of the stock you're going to give, plus whatever the difference is to make the journal entry balance to 500. You are not going to have a gain or loss on the conversion of these bonds into stock, except in very rare cases where the conversion factor was entirely not expected. And that seems to me to be kind of silly. Why would you have a conversion factor unless you expected that to happen? So that just doesn't happen very often.